The residential real estate market in Canada. National real estate prices are still relatively high in Canada, having reached all-time highs at the beginning of 2017, then leveling off again in July of that year. The national price average for a home was just under 504,000 at the end of 2017. According to the CRA, even with the slump in the market in April, the national average price still rose around 4.9% in 2017 compared to the previous year. Canada's market is quite diverse considering its geographical vastness, as well as the range of industries and ethnicities it homes. The two main drivers and leaders in the market being the Greater Toronto Area and the Lower Mainland and Vancouver. To put it into perspective, the Toronto area alone comprises around a quarter of the market in Canada. Population levels due to trade with the United States are highest right next to the US-Canada border, leaving the rest of the country relatively undeveloped. According to Statistics Canada, 97% of Canadians live within 2 hours of its southern border. Many areas around the country, unlike these other hot marketed zones in Toronto and Vancouver, have been quite slow for many decades. Take Newfoundland, which has such a low rate per quarter, the CREA does not even register it on its general statistics. The provincial average price of a home in Newfoundland at the end of this last year was $249,480, less than half that of the national average. In the whole year of 2017, only 369 units were sold throughout the province. Compare this with the Lower Mainland area of Vancouver, where the average price of a home is more than $1,050,300 per unit. In other regions, such as the prairies, where agriculture and the oil and gas industries are the main source of the economy, things continue on a slow but steady recovery from the 2014 downturn, after the price of oil plunged around $30 a barrel. In some areas, such as Fort McMurray, most homes' property assessment dropped by an average of 70 to 80,000 within the first year of oil prices dropping, becoming an almost 20% decrease in value. Due to the Canadian economy's dependency on natural resources and the fluctuation of world prices, this can lead to what's known as booms and lows. In these boom times, jobs are more easily obtained and higher paying, mostly in the trades and similar sectors. In times where natural resource prices drop, many Canadians find themselves filing bankruptcy or liquidating assets due to the size of loans they received while they were employed at higher rates. Another contributing factor to this is the lowering of interest rates in Canada for the last number of years. Now that interest rates are on the rebound, many Canadians are being put into what the federal government calls the stress test. With such low interest rates and easy rates of approval, the federal government decided it was time to regulate personal mortgages more tightly as of 2015. In turn, the downturn in many of these industries losing revenue affects the rest of the country, where Canadians were more willing to buy non-necessities or stretch their line of credit in boom times, now are more concerned if they can finance mortgages or similar expenses. The CREA's forecast for the upcoming year has anticipated that there will be a downturn in the amount of medium to income housing sold due to the new federal regulations that took effect as of January, putting a tighter stress test on would-be buyers, rendering them from qualifying for higher mortgage loans. Also contributing to this is the continuing expectancy that the Bank of Canada will raise its interest rates in the coming years, having done so at the beginning of 2016. Based on research by Atlas Group, the forecast predicts an annual decline of more than 27,000 sales from 2017 to 2018, translates into a decrease of 1.1 billion in economic activity and nearly 12,000 fewer jobs nationally. In closing, the CREA's current review is that it is a buyer's market. The national average price is expected to reach $510,400 in the coming year, up to 4.2% from 2016.